Let's see. It looks like people are trickling in still a little bit, so I'll just wait another 30 seconds. But again, just thank you for being here. And again, if you're listening to season 8, episode 1 of the Restaurant Boiler Room, very thankful that you've tuned in for all these years. It's a blessing to have kind of people actually listen to what you say. It's crazy. We're going to do a State of the Union now. Hopefully, you'll find this hour is valuable. No, if you want to ask any questions, please feel free to do so in the Q&A. We'll try to watch it. And then ground rules here, don't worry, don't fret. If you're on this webinar, we'll send you a replay, and it'll be on our website at unbridledcapital.com as well, so you can catch up. And then the format here is we're going to we'll go through like 9 or 10 questions. We'll spend about 4 or 5 minutes on each question. We're going to talk a little bit about what the same question from last year produced, and then we'll go into the current situation and give you hopefully a handful of thoughts to think about for this year. And as always, if you have any questions afterwards or as you push into January and February, call us. You know how to reach us at Unbridled Capital. So here we go. So we've got Derek Ball, we've got Peter Fisher, and Raymond Buehner on the line with us. And so let's go ahead and jump into question number 1. And I think, Raymond, you're going to take it. Last year and this year, we'll ask the same question. Just a commentary is our first question on the current supply and demand of buying and selling franchise assets. So go for it.
Yeah, thank you, Rick, and thank you everyone for joining. So yeah, I'm just going to dive into kind of what we talked about last year. The first topic was commentary on current supply and demand for buying and selling. So at this time last year, I think we had 7 active assignments across 5 different brands. We kind of expected it to kind of stay slow in Q1 and Q2 of 25. Part of the reason of what we said last year is, there's not as many sellers when you're having large sales comps, which is kind of what we've seen early on in Q1 and Q2. There were strong rollovers. And also cost inflation was starting to moderate, and that was helping a lot of existing franchisees with their core operations. And I think, the thing we talked about last year is a lot of people were in a wait and see approach. Trump had just taken office at that point, and there was a lot of optimism, kind of in the franchising industry and looking forward. So when, that's kind of the mindset when you think, things are better in the future than they are today, that kind of limits the amount of, sellers that want to come to market at that point. Last year, let's see, we saw EBITDA multiples start to come up, kind of a quarter turn, nothing crazy. And there was a lot of big interest in large deals last year. We had a couple very large assignments with many offers on them. And we also, branched out to a couple of different brands last year, and I think that's about it.
Yeah.
Good. So I guess how's that compared to now, Rick?
No, it's a great synopsis. I think that's fine. And so deal flow, the punchline here on buying and selling in 2026. I think the first thing would be, wouldn't you guys say that? I mean, we have right now 7 deals that we're working on, probably $600 to $700 million in total transaction size across the same. 5 brands, so that's the same kind of breadth. So we're kind of seeing the same sort of mix. Like deal flow continues to be light. We feel like it'll probably, at this time last year versus this time this year, it feels about the same in terms of the inbound inquiries. And you don't see like a lion's share of business coming from one particular brand. It just seems to be more targeted deals that come up, one or twosies in different types of brands across the spectrum. Any other comment that you guys see for 2026?
I think it starts to pick up a little bit. We had a note in our comments from last year that during this call last year, we had 3 to 4 inbound calls in January. My guess is we're at like 5 or 6 now. I'm not sure which of those will stick, but I think the inbound calls have been just a slight tick higher than in 2025. And if we look at like Q4 of 2024, it was dead. There were no deals in Q4 of 2024. Now, Q4 25 wasn't extremely busy, but it was definitely busier than 2024. So it does seem to be picking up. I don't think 2026 is going to be a gangbuster year. People that I talk to regularly will have heard. I think either this year, next year, or 2028 will be a huge year. One of those 3, I don't know which. But I think there's still a massive amount of pent up demand on both sides of the deal flow. And I don't know what it's going to take to get that to light, but it'll light here soon enough.
Yeah, there are a couple of other comments about buying and buying, selling, supply and demand. We took 15 assignments last year and closed 13. That's what's the statistics on that? Like 85% closing rate, which is a little bit lower than what we normally are. We're usually around 90%, but again, it's kind of close within rounding. We've heard some third-party commentary from rather large investment banks that say that 60% of the U.S. deal flow in M&A did not, I repeat, did not close in 2025. So it was a year of and you saw some activities with some really strong franchise brands, and then you saw the dichotomy of some distress that started to happen, precipitated maybe by store closures or over leverage, and some of the brands have been languishing from a same store sales standpoint. But it is notable, if true, that actually, and I had a corroboration of this on someone else that also said that number was similar with their investment bank. So about 60% would be a good number of deals that went to market last year and didn't transact. A little bit kind of and I had that fear that would happen in 2025. I mean, look, we didn't have in the past year, the same store sales comps weren't that great in a lot of the brands, were they? We saw a notable downshift in Q2 and Q3 of last year. And then, like it or dislike it, we all have our opinions on the political environment, but the ICE raids and everything, really affected some brands. I had a franchisee who I know in Chicago who said his sales were impacted 5 to 10% because people were just, illegal people were afraid to be out in the streets and afraid to be in QSR. We have this growing thing in Ozempic, which I think, I mean, look, it's a real thing. 9% of Americans have tried the shot. 20% of American households have at least one person who is on Ozempic. These are stats from PwC. I heard this just a couple of days ago, and it's expected to grow remarkably. So, Ozempic and this kind of thing it could be the next AI of food. Like really, like I think could be that big, especially as they put it in a pill format and drop the cost as low as it's been. So there have been some headwinds. I mean, in 2025, but I think as we roll into 2026. More brands than not are rolling over poor comps, and sales comps seem to be up a little bit in several brands, if not a lot in certain brands. Like you're hearing like Burger King is up a lot with the SpongeBob SquarePants promotion, right? I mean, Taco Bell's doing really well right now, and there's a host of brands whose sales trajectory on a trailing 12-month basis is starting to improve and change. So that's question number one. I think that's probably enough time. Question number two was, what do we expect for M&A activity in 2026? And so I guess Peter, this is on you. Go back to last year, what we thought we would hear and what happened, and then let's keep going into this year.
Yeah, so last year, and Raymond kind of touched on it on the first question, but we were really slow at the beginning of the year. I thought so because of the election. We stated that since Trump did win, that the M&A market would probably slow down at the start of the year, but possibly pick up towards the end. Also thought that since supply would be limited, it would favor the seller because of pent-up demand for the buyers. Mentioned positive comps would help with diligence, but also help hold the valuation throughout the deal process. But for the later half of the year, comps would be a little harder to roll over. And then we also mentioned a little bit about smaller emerging brands starting to gain some market traction and desirability in the M&A world, which is probably still the case today, honestly.
Mm-hmm. Mm-hmm. Yeah. Well said. I mean, I look back on those comments, and that's pretty much how the year played out, actually. So we were mostly right. There's a couple of trends that have changed dramatically, I think, in the last 3 or 4 months that are going to affect 2026. So there's, a couple of themes here that we'll reiterate over and over again. But for 2026, I think the big trend is going to be, and we're going to have to develop this. So I'll make a couple of comments, and then Derek, why don't you roll into this a little bit too? But we're in maybe the 8th inning or maybe now the 9th inning of franchise consolidation. Back in the good old days, people that you had mid-sized franchisees and a couple of big franchisees in 2015 and 16. You started to see this trend as the Harvard MBAs started getting into the space and started trying to consolidate these businesses with the principle that they could get in on a reasonable multiple, buy down their multiple by buying other restaurant or franchise assets at low prices, and then develop some stores where it made sense, hold their asset for 5 to 7 years, and then sell it for a higher multiple to a bigger buyer. And that has largely been a failed and flawed and failed approach. over the last couple of years. So much so that in a recent deal, it was, over 100 units. We solicited offers for the whole business or in pieces. The whole business got 8 times EBITDA and the pieces got 10.5 times EBITDA, roughly speaking, each. So there is as much as a 20 to 30%, depending on how high the valuation is of the company and what multiple it sells for overall. There is as much as a 20 to 35% difference in selling a huge company versus a smaller company. So what does that mean? It means that these financial buyers can't sell their businesses to bigger buyers. Financial sellers can't sell their businesses to bigger buyers at increasing multiples. And so what do you think they're going to be doing now? They're going to be splitting up their assets and selling them in chunks to owner operators and mid-sized strategic buyers. And it's going to unfold like a daggone hurricane in 2026. You watch. I've been saying it for 12 to 18 months, and this is the year it's going to happen. And what will happen when that happens is all of a sudden you'll have a 400-unit franchisee who sells 8 50-unit chunks, and the market can't hold that much supply. Demand, the demand will drop because of it, and prices will drop with it. And I think that's probably the big aha point that we would make. There's a couple of other ones, and we'll save them, of course, for later of the conversation, so you guys have to listen, right? A little teaser, but that's really a big trend that I think is going to happen. And who does that affect? It affects the mid-size operator. It affects the big guy who wants to sell in chunks, yes. But it also affects the mid-size operator who has 30 to 40 restaurants or franchise assets outside of restaurants, who's wanted to sell over a 4 to 5 year period, but hasn't been able to, missed the 2021 window, and has been holding, getting older and older and older, knees hurting more and more and more, like mine and everybody else's. And then they now think that in 2026, when the trends turn around and maybe the commodities ease a little bit, they're going to sell, and they're going to sell for a multiple that they could have gotten close to 2021. But what's going to happen is when this hurricane happens and these assets come out in chunks, that philosophy is not going to come to fruition. Comments? What do you guys think?
It's interesting. It's not something that I think that's happened in the past. This will be a first time type of event. We're seeing it specifically, in one brand right now. And that brand trades at such high prices that it's tough for people to want to spend the amount of money that it takes to buy those 200 unit portfolios right now. You're not seeing the PE guys wanting to do that at the top price, and you're not seeing sellers willing to sell it at a discount effectively. So you're seeing them being split up. Now, whether that happens in brands that are only trading at 5.5 to 6 times, it could be a little different. It may be less drastic in that situation. Maybe you've got a 300 unit company that trades at 6 or 6.5, and you're just having trouble finding that buyer. Maybe you don't see a massive increase or decrease in multiple necessarily from splitting it into 300 unit pieces, but you at least are able to transact. You might not find the buyer willing to transact for all 300. And even if the multiple doesn't necessarily change, the only way you can sell it at all is to split it up and find those few buyers. Our opinion is that's what's going to happen. When that happens, let's just say, let's do one example like Rick just used, a 400 unit franchisee splitting it up into, let's say, 8 to 10 chunks of 40 to 50 stores. It's going to flood the market. And effectively, when you hear about multiples, people always call us, what are multiples, in this brand or that brand? You only hear about the winners for the deals. We don't quote what the average offer was for a business. You hear what the winner paid. And, let's say we get 8 offers on a business. There's usually 1 to 3 in that tight range where the winner was. But then you've got the 4 through 8 that were not. And if you're splitting something into 3, you can solve for that. If you're having to split things into more than that, and you have 8 deals out there, you've got to time it well, because there aren't 8 buyers at great prices for those 8 businesses. You're going to have to time it over 12 to 18 months in order to do so. And you're going to have to figure out how your company runs during that process, during that downsizing. So it's going to be a little bit more of a, more of a thought challenge on how you keep your business running well especially with your team seeing you downsize at that time, because you can't just throw 8 deals on the market at once. That's not going to work. You're not going to get max price, nor could you do 8 deals at once as a seller. That's too big of a lift. So it'll be interesting to see how that plays out.
Yeah, and I think this affects, and like I've been wrong a lot of times in my life. This is just just an opinion and a perspective, but I think I think I'm going to be right about this. It's going to have a draconian effect on this industry over the next couple of years. Like we have all of a sudden gone from wearing short shorts on the basketball court and socks up to our knees to now we're wearing baggy shorts and no socks. You know what I mean? Like it's going to be a seismic change as we unwind a lot of this consolidation. And it's going to happen not just with the hot brands where they have, I have 300 stores. I thought I was going to sell it to a group in Dubai or Puerto Rico or wherever for a massive multiple, but now I can't. They don't buy them anymore, so I'm going to split it up and sell them to strategic buyers who are already franchisees. That's not at higher prices. That's not the only way this is happening. It's like I've got a 50-unit company now, or let's just say an 80-unit company that has $1.3 million AUVs, 9% rents, some remodeling requirements, and no fee properties in there, and it's showing like $4 million of post G&A EBITDA. Like no one is going to buy that business because on the other end, you have a buying community who are mostly strategic buyers who don't want to sign up for all of those leases. And the people who drive the pickup trucks in Des Moines, Iowa and want to operate 30 or 40 stores don't see these leases in the same way as a private equity or family office would. They don't say, oh, I don't care whether I own the real estate or not, right? They don't say that. And they don't say, I don't care if I sign up for a master lease, or I don't care if I sign up for 50 leases here. They're looking at like, yo, I got to sleep at night. If I'm going to take on 50 stores that are barely profitable and I'm going to have to sign up 50 leases and the average lease is $80,000 a year, that's $40 million in annual, or whatever the number is, lease liability, $4 million of annual lease liability. I can't do that. So it's going to force the consolidation to unwind at the lower end as well. We saw a couple of things, and I know we got to go into the next question. We saw a couple of things this year. There was continued to be a bifurcation. Big brands that are doing awesome continue to be going hard at big prices and a lot of interest. And then, we've seen the bankruptcies start to unwind. Maybe the bankruptcies are starting, you kind of have to, separate the wheat from the chaff, Bible terminology, right? So after a while, you can cull and you can get back to what's normal. But usually, like a bad cold, I think, Derek, you got the flu, right? Usually you feel worse right before you get better, and sometimes the bankruptcies and the distress and the store closures happen at the very end of a cycle that's about to turn around. But clearly, we've seen several notable examples in recent days. There was a big Popeyes bankruptcy, Chapter 11, that was just announced this week, and several others on the docket too. So that's something we're noticing. Okay, that's a lot of Rick talking. What about question number 3? Everyone wants to know about EBITDA multiples. So let's do a deep dive on EBITDA multiples, where we were, where we are, where we expect to be for 2026. I think it's you, Raymond. Fire away.
Yeah, just jumping in here. So next topic is EBITDA multiples and cap rates. So a lot of the commentary last year, we said EBITDA multiples were leveling, if not slightly increasing, probably a quarter turn. Specifically in the legacy and kind of struggling brands, those have been coming down for quite a while. And last year was kind of the first point where we saw them level off and, increase in some cases. The hot brands, they're still well above historical pricing norms. There's a few specific brands out there that are just well and above the rest. And we were seeing emerging brand franchisees. There was less than expected deal flow. And that kind of, what we posited last year was inaccessibility to financing for some of these newer up and coming concepts still at that point. We talk about how geography is also a major factor and can be as much as a, 1-turn gap depending on the area of the country you're in. And also kind of, it's funny, we said this last year. We said the stock market was fully valued last year. Rates coming down on money market accounts as well. Very, very interesting.
Yeah.
Just
wrong about that one, weren't we? Wrong about that one. Yeah, who would have thought? That's good. That's good. I mean, one thing I wanted to make a comment on from the last comment about the supply and demand. I typically get, a lot of these inbounds when someone decides they want to sell or finance their company, they'll call me. I would say like last year at this time, we had 3 or 4 of these inbounds. Derek says we've had 5 or 6. So they're a little bit higher on the franchise restaurant side. But in the last like 90 days, I've gone from like last year, I had 1 or 2 phone calls. This year, I've had like 4 or 5 phone calls from emerging brands. I've got a phone call from like a GNC type brand recently, a fragrance franchise recently, a window franchise. I mean, like, you know what I mean? So, and these businesses are gradually but surely kind of building enough EBITDA to hit our radar. Like one of them had $1 million in EBITDA, one had a couple like 4 million in EBITDA, one had like, like 6 million in EBITDA, right? So these businesses are gonna, I mean, I can just feel the momentum coming. I mean, we do still 90% of our business is restaurants, but probably now 30 to 40% of the phone calls I get are out of restaurants or not restaurants. And I think that number is probably going to continue to slightly change on the uptick as we go into 26 and throughout. Multiples are typically in 3 buckets, right? So bucket 1 is the top tier brands like the Taco Bells, the Wingstops, the Planet Fitnesses, the 7 Brews, maybe a little bit of the Dunkin' businesses, maybe a little bit of the Jersey Mike's. There's others, but these are the ones that might sell in the 9 to 11 times EBITDA range, and they're selling. The brands are doing great. There's tons of interest. Everybody wants to buy into them. And that has not changed much. If anything, it's maybe gone up, maybe even a little bit more, but it's probably stayed about flat since this time last year. The second bucket is these businesses that are selling for like somewhere between 6 and 8.5 times EBITDA. And it just, there's a lot of them in this bucket. This could be something like a Zaxby's that has like a decent chunk of stores, but really good performing stores in a certain geography that has a lot of interest. It could be a brand that's kind of a somewhat emerging that has really good performance. It could be a brand that's kind of high and doing well, but not quite on the same tier as one of the first tier brands. There's a bunch of reasons why you'd be in that bucket. That they have done okay to well in the last year, and obviously a lot of more emerging brands are hopping into that bucket as well. The majority of the brands are sitting in the 3 to 5 times EBITDA bucket now. And these are a lot of the legacy brands that we've been working on for, a lot of years. You've seen them. They're the ones that have 3 or 4,000, 5, 6, 7, 8, 9,000 stores. You know them. They've had same store sales and negative comps, store closures. Those brands are certainly, kind of languishing still. Obviously, a lot of the burger brands have had a big uptick in beef commodity costs that we don't think are going to subside until probably the end of the second quarter of this year, but we should get relief in 2027. It's a material impact on EBITDA. Some of the other comments is geography. You talked about geography. I mean, heaven forbid trying to sell an asset in Minneapolis right now. You know what I mean? It's just things like this that make a big difference. And it could be more than the 1 turn of EBITDA that Raymond just mentioned. That would be the difference between like 5 times EBITDA and 0 times EBITDA, So and that bifurcation is happening all over the country. People in Texas still want to buy things in Texas at big prices. Same with states like Florida and Tennessee and, North Carolina and Georgia, places like that. Any comments that you guys might have on EBITDA multiples? I know I've talked a lot. Sorry.
One of the things that we were talking about earlier, Rick, is how do you get the multiple up? If you're a potential seller, how do you kind of prepare your business, not in every aspect, but how do you prepare your business to try and maximize that multiple? First and foremost, get your EBITDA up. Just operate your restaurants well. That's the one thing, I think, the most important thing that you can control. I think so much more than it used to be in franchising with all the national advertising, the local advertising is so limited. If you're in a brand that's just in a rut, there's limited things that you can really do. The brand itself is essentially the end all be all when it comes to marketing and LTOs and all that stuff. You can't necessarily control it. And a lot of brands don't care what you have to say. Ultimately, that's just unfortunately the way it is. And you have limited local marketing dollars unless you're dipping into your P&L to really do anything because it's all going to national. Operate your stores well. Don't cut corners. Maximize your EBITDA. Close underperforming stores. Now, some brands are a little bit nicer than others. but Rick is always very loud about closing the stores that are dragging your business down. It's not just EBITDA. If it's a couple hundred negative EBITDA, a couple $100,000 of negative EBITDA, absolutely, it's going to materially improve your price because buyers will factor that into their price. They don't just wipe it out and call it a zero like franchisors like to do when they're refranchising. That's not how the real world works with franchisee to franchisee deals. But you know, if you can just get those out of there, it just attracts more buyers, and it will improve the multiple as well on the rest of your stores because it's not dragging your business down. And if you have 10 out of say 40 of your stores dragging it down, it takes a really nice 30 unit business that would find multiple suitors and makes it almost unsellable. Literally almost unsellable. And we have some comps that demonstrate that. Negotiate remodeling requirements if you're able to. Some brands, every brand's a little bit different. Some brands don't allow negotiations, some brands do. But if you can, you know, I don't know, if these are $1 million requirements, you know, some brands only have $250,000, $300,000. Those are often manageable. If you're in a brand that's forcing 500 to $1 million on a remodel and your store's making 50 grand a year, that torpedoes a deal because the buyer is going to factor that in, and effectively that asset just became a negative value. And then if you've got good stores with short-term leases, try and get some extensions on those. If you've got bad stores, don't get extensions. Just try and get out of them as quickly as you can. But if you've got good stores with 3 years left on a lease, buyers are going to look at that as a risk. So get extensions or options on profitable locations.
Yeah. Yeah.
Anything
Well
I missed
said.
there, Rick?
No, I think that's great. I mean, I've just said it over and over again. I live my life this way. So, I mean, I live my life open book. Yeah, I live by Pareto's rule 100%, which is like, you know, the 80-20 rule, right? So like if I'm operating restaurants, and I'm not, I run a different business, but I like don't try to fix the things that are going really poorly. I just dump them. You know what I mean? As quickly as I can and focus on what's making me successful. Like, why would I be struggling? You know, so take that mentality to your restaurants. Now, I also admit that when you sign long leases, you know, and you have a franchisor breathing down your neck, you can't maybe act as cavalier as I'm describing, but you can, I mean, you can put pressure on the franchisor if it's a store that's terrible. You can negotiate with them. You can take another development ask in exchange for a store closure. You can sublease a building. There are tons of emerging concepts that are really killing it, especially if you're a legacy franchisee who's on the corner of Main and Main and your store's not just working anymore, but Chipotle would kill it there. So, you know, be thinking that way. You know, you shouldn't be spending time on your losers if they've been losers for a long time. They're never going to be winners, right? So that's just the way I think. I'll talk a little bit about cap rates, and I don't think we need to visit last year's cap rates. I'll just kind of throw some points out. You know, we have a friend, Chris Lamuto, who helps us with some of these you know, cap rate analyses and things. But I'll just read some of the stuff. You know, like it looks like across all sectors, 6.2% cap rate is, you know, it's fallen about 20 basis points is about where the comps are showing us that it is. So the pricing is getting a little bit better for people who are selling things, probably because interest rates are going down and some of the supply and demand is becoming slightly, if not marginally, more favorable for sellers. Now we're talking about 1031 real estate, not real estate investment trust buying things in bulks. We're talking one-off restaurant sales. So you have to be very careful about what you interpolate here. People throw around the like inappropriate cap rates at all times. And like I had just a discussion with someone down here in South Florida, and they thought the cap rate for, you know, single property real estate was like a full turn worse than or better than what it was. And, you know, like when you're talking at something in the fives, you know, like one full turn is a whole 25% off on the value of your real estate. So he thought his real estate was worth 50 million and I thought it was worth 37 million. That's a material difference. So you need to get these numbers right. But it just looks like we've seen, you know, we haven't seen a whole lot of REIT sales. The activity in the marketplace would be similar, I think, to the franchise M&A space. Cap rates have gotten a little bit better, and there continues to be a gap of about a little more than 200 basis points between probably the worst trading sector, which continues to be office, and the best trading sectors, which are either QSR or maybe convenience store, gas station kind of things. And then in the middle, you've got the car car washes, and you got the grocery stores and the industrial, type of buildings. So that's kind of where the cap rate market is. And of course, it changes a lot based on the area of the country. What something is in Iowa and South Florida are going to be way different, even with the same asset on top of them. So any comments there? Probably not. Anything material? We'll move on to the next question. Who's got this one? The lending market. What's happening to the lending market?
I can take that one. Well, last year at this time for lending, most lenders seem to be more optimistic than in recent years. With such little activity across the space, we thought lenders would be heavily competing for new business, which would ultimately favor the seller. However, we did mention that struggling brands and/or business was still finding it a little challenging to find good financing terms. Overall, we thought the lending market was in a good spot for sellers or for buyers. While at least adjusted leverage was very important and in that 5.25 to 5.5 range. A greater focus will be placed on fixed charge due to higher interest rates taking up most of the fixed charge. This year, SOFR has dropped almost 100 basis points versus last year. I think last year we're at about 4.5%. This year we're hovering around 3.6, 3.7. And most deals are priced on SOFR plus 200 to 300 basis points, but obviously can be a little lower or higher depending on the brand and the business.
Yeah, that's great. Mostly any other comments there? I mean, I guess I would say, one of the things that just and so we always have a couple of lenders on this panel, just listening. So they'll probably someone make a comment to me if you don't agree. But lenders typically look at things in arrears, kind of not quite like a CPA, who looks like a year in arrears. We look at things like at the moment they happen, right? So we're like watching the, like what it happened the minute it's happening, an M&A advisor. A bank typically is somewhere between 3 and 6 months behind. So they're typically getting the prior quarter's financials for their covenants and things. And sometimes those things are in arrears. So we could be as much as 6 months in they're behind. And so they may not always have the most current view of the marketplace, which is why they listen to people, hotheads like me, yapping all the time. And I'm thankful for that. A lot of good friends in the commercial lending world. But I think just in general, you've got to be careful that you understand what your last 3 to 6 months have been and what the next 3 to 6 months of your business are going to be as you put a business for sale or as you're buying a business, because your lender may not always be in step yet with the current trend, and you don't want a surprise. Hopefully that made sense. Okay. Number 5.
One question we get a lot is do you see any seller financing? I figure this might be the question to bring it up. Interesting question. In the past, we thought, things would have to get, kind of bad, to the point where lenders weren't, you couldn't find debt, things like that. And essentially seller financing or earnouts, things like that. My new theory is things will have to get extremely bad, worse than anybody on this call would ever want to see, for sellers to really start throwing that out there very often. I mean, even over the last 2 years, we've done no deals, I think, with seller financing. We did one handful of years ago in a special circumstance type of thing, but not a traditional seller financing situation. So I'll tell you all, if you all ever start hearing about QSR, and other industries, I think, are a little different when it comes to earnouts and seller financing, but QSR with the national lenders we have in this business, if you start seeing a lot of seller financing and earnouts, my guess is things aren't going well.
It's not good.
And worse than we could ever imagine, considering we haven't seen like any of it the last few years. So go ahead, Rick.
Well, good. That's a great comment. It's a great comment. We have a question here coming in. What about burger brands? All right. What about burger brands? We have Burger King, Five Guys, Habit Burger, et cetera, et cetera. What do we a comment?
I think he was asking when we were talking about multiples.
Oh.
Yeah. In terms of Five Guys and Habit, honestly, we don't really have a whole lot of comps there. We don't hear a lot of deals trading. We see things posted online, oftentimes that we never hear about actually closing or comps. In terms of Burger King, it's hard to tell. I mean, prior to November or December, I would have thought somewhere between 4.5 and 5.5, depending on geography, the quality of the business, unit count, EBITDA, things like that. That's probably the range it would have been. I don't know about post SpongeBob. I mean, we were hearing massive up comps. I mean, apparently, to any QSR executives out there, you just throw SpongeBob on something and you'll see a plus 20 immediately. That's every brand should just start partnering with SpongeBob, apparently. Just
And
make sure
Wendy's
you
did
get
it too.
enough product. But so I don't know. I think the multiple range probably hasn't changed much. Obviously, they've got better EBITDA now. Maybe the 4.5 to 5.5 is 4.75 to 6 now, depending on all those factors. You know, Burger King seems to be doing pretty well compared to a lot of the legacy brands right now. But
I mean, traditionally speaking, and Wendy's has gone through some struggles recently. Traditionally speaking, Wendy's was probably more towards the upper end of the model that we would kind of follow. I mean, you can't really buy and sell McDonald's freely, so we don't consider those as much. And then you have a bunch of burger brands that are down here in the 3 to 4 times EBITDA range, right? I don't want to mention them, just not fair to them, but and then most of them would kind of be in this 5 to 5.5 times EBITDA range, just traditionally speaking. But I think we speak sometimes a little bit too much about the multiple and a little bit too infrequently about the EBITDA. So the multiple could go from a 5 to a 5.5, and that's really just a 10% increase in the value, right? I mean, and that would be a pretty big jump in value. So whether I say your business is worth 5.5 times EBITDA, 5.25 times EBITDA, 6 times EBITDA, we're really just talking about 10%. But the EBITDA itself has fluctuated by 50% or more in some of these brands over a couple year period, right? Like, so in the burger brands, when you say, what about the burger brands? My comment is high food cost right now, really high beef prices. Have you been to the Kroger or wherever, Publix recently, and tried to buy ground chuck? Holy cow, it's like gold. I mean, I don't know what the heck has happened, but it's hopefully going to be coming down, but it's going to take a while. So we got that kind of thing going I think there's been also, there's been a lot of trading. I mean, the burger space particularly has a lot of trading. It's like a zero-sum game where some are up and some are down. Right now, Burger King's doing pretty darn well. And Burger King would be one that is building a good trailing 12-month P&L, aren't they? With the SpongeBob promotion and then several quarters, I think, certainly months behind of positive sales. So I don't know the number, but at this point in time, Burger King's probably trailing 12-month financial statements got to be 5 or 6% up in sales over the prior TTM. And that's typically a good time to sell. Now, the old timey folks got this wrong all the time, and they said, "Oh, we're only going to sell something when times are bad, and we don't want to operate it anymore." It's not the time to do it. Time to sell something is when things are going pretty well, because that's when someone wants to buy it and they'll close it without retrading it because the bank won't finance it. So if, like, you're a Burger King franchisee, you're stepping into a year, especially this spring, where you've had a pretty good 12 months. This would be a time, if you're 70 years old or whatever, or you're wanting to move to Africa, whatever you want to do, this might be the year, especially in the spring, to be kind of looking at your P&Ls and making some decisions, I would think. Okay, question number 5. We're not going to get through all 10, but that's okay. We'll just go till the hour and then we'll end. Question number 5 is, yesterday's buyers were family office and PE consolidators. Who are today's buyers? So we kind of knew that trend was starting to last year, and it certainly exacerbated this year. Go ahead. We're summarizing last year.
Yeah, so last year, the answer we gave to this question was it was primarily strategic buyers have kind of come in and taken over a lot of the PE purchases that had happened in prior years. Part of the reason for that is, PE, they talk to each other. They had been burned on a couple, pretty notable transactions. And what PE groups were looking for is development upside and sales growth. And, frankly, there weren't a ton of brands that were doing that at this time last year. We also said, kind of mid-size franchisees, they were also coming into the space. And existing franchisees who are maybe, slightly undercapitalized that, have some positive sales and are, put embedded equity into an acquisition. Those are some of the deals we were seeing last year.
And now, like one of the trends has got to be, and I'll just throw it out here and you guys talk about it. Like, we've got a Freddy's deal 4 offers, most of them from outside of the system. You know what I mean? We got a Popeyes deal over here, couple offers, none of them are inside the system. So how is that factored into this year as well? What do you think?
Yeah, it seems like so on those 2 deals, out of the 8 to 10 offers that were received, only one of the buyers between both of those transactions was within the system, which is interesting. It's usually not that way. It's usually the opposite. So, I mean, generally speaking, as we said on this call, we're not real optimistic. There's a lot of PE groups out there looking to buy massive companies at strong prices. But that doesn't mean outsiders aren't coming in. They're just a little bit different of a makeup. Like these were fairly small size transactions, 10 million or smaller in terms of deal size, a couple $1 million of EBITDA each. So not massive deals. But they were attracting groups that were kind of starting a second career looking to get into franchising. That's kind of the makeup of most of the buyers that were offering on those businesses. So all the news in franchising can't be bad if we're still bringing in new people all the time. You know what I mean? So, but it feels like the larger deals where you've got to put in 50 million of equity or more, those are the ones that are getting a lot more scrutiny from the PE groups, and they're a little spooked. They're a little spooked at the franchisor situation than a lot of brands having the control they have and seemingly trying to take more, and kind of at the whim of the C-suite, really. Do you have a good marketing department this year or do you not? And that seems to like make or break franchises nowadays, and there's nothing as a franchisee you can do about it. That's why you see, in 2025, I think most of the PE deals I saw were franchisor deals. They like that control. So PE is not like not spending money. They're spending plenty of money. They're just a little more picky on where they're putting it. But these small to medium sized deals are attracting kind of medium to small outside groups looking to make an investment. Maybe their first one, maybe their second one.
And that's probably the second of our big insights for today. The first one is we're at the end of the consolidation phase, right? And at the end of the consolidation phase, all these businesses are going to break up and sell in pieces, whereas they were going to be sold to a consolidator or a larger buyer. And that has repercussions for the franchise system, no matter if you're a big franchisee or you're a mid-sized franchisee, because the supply-demand dynamic is going to change dramatically moving forward. That's the first big point. The second big point, and I think it's as equally big, is that the risk return model in this industry is changing. It's changing, and it's attracting a different type of person to it. In the good old days, you would look at franchising and restaurant franchising particularly as like up 1 or 2 points, down 1 or 2 points in same-store sales. EBITDA is relatively flat year to year. It was a good cash-driven business with a 90+% success rate. You were hitting singles. Maybe you could slide into second with a double, but that's how you were doing it, right? And it was a good, predictable, long-term business. Hold the real estate, keep it, build a legacy, do it over a long amount of time. You saw all these friends of mine who made all the money in the business over a long amount of time, not a short amount of time. And then they would gradually start trickling some of the dividends and money they were making into other things, other businesses, other real estate, other ventures. And that's kind of how they grew their net worth. Today's franchising model is different. It's not to say that it's better or worse, it's just different. It's much more peaks and valleys. I mean, come on, look at the last 7 or 8 years. It's crazy. I mean, this is a business where you could either go in and you could strike out, whereas that wasn't really easy to do, maybe as easy to do in the past, or you could go in and you could hit a triple, whereas that was not very easy to do either in the past. It's just the risk and return has changed. The peaks and valleys are way different, and these brands are moving in and out of favor at a much quicker pace based on consumer preference, based on Uber Eats and all that stuff, based on Ozempic, like whatever it might be, but also based on the management team of the franchisor, which seems to continue to be in one door and out the next with someone else with slick and fancy shoes who stays for 2 years. So should so that is in it of itself, the change in risk reward profile changes the type of person who buys these businesses. It just changes the very nature of it. Now you might see 3 40-year-old guys who had a background in salesman at Medtronic, and I don't know, I'm making this up, and they may have $4 million. They're smart, but they're not PE guys, and they want to go and operate a private business, and they come together and they buy a 40-unit franchise. That you could see how that model would play into a world of different risk and return, as opposed to this hitting singles 1% same store sales up and down. Any comments you guys would have, or we can move on? Sorry, I got going there.
No, all good. We got a couple questions here that I'll just hit real quick.
Yeah.
One, which area of the country commands a higher multiple? You know, someone came in behind that question and kind of answered it. Blue state versus red state. There's exceptions to everything, but you know, and I'm not going to name the states that I would list on the bad side. We try not to ever call out things if it's not a positive, but there are a handful of states in the country that are becoming extremely difficult to sell. There are exceptions. If it's a Taco Bell business or a Wingstop or a Seven Brew, you know, there are exceptions. But if you've got a struggling business in a state that's not real friendly toward businesses, it's going to be tough, and you're going to take a massive hit on your multiple. Someone asked about Hawaii, Puerto Rico. We don't really do. We haven't really historically done deals outside of the mainland.
Oh, you just probably haven't listened to me talk enough if you ask that question, because I'm just a crazy man who gives examples that don't mean anything. So I didn't mean anything by Puerto Rico, you know, other than it's in my mind with no state, you know, no income tax if you're an Act 60 residence, you know, but no, it was no comment on Puerto Rico particularly. But there are multiple.
But we don't know what the multiple differences are in Hawaii, Virgin Islands, Puerto Rico versus mainland. We don't have comps for that.
But like anything, we could probably opine. I think we would opine, and I think be correct in this, that it's all about supply and demand in anything you have in your life, right? So the supply and demand in Hawaii, and I'm part Hawaiian. I don't know if you can see, I kind of got the Hawaiian skin. I'm part Hawaiian, so I know the Hawaiian Islands well. It's just not as much demand there, right? You know, and part of the demand is to buy something is going to be coming from Australia and New Zealand and maybe China and Japan, right? But overall, it's not going to have as much demand as something that's going to be sitting in the middle of the United States, just because of supply and demand. So,
we have another question that's going to be how do you see lenders, you know, giving credit for pro forma adjustments? This is relevant. We talk about it with sellers a lot. You generally will not see big pro forma adjustments from unbridled deals. You will see if a store is new, obviously we're going to pro forma that. If it's been open 3 months, we're going to show a full year. That's the store you're getting. If the store was shut down for a massive remodel for 3 months, we're generally going to try and normalize that as well. You don't see us, if you just took a pricing increase yesterday of 5% and you want us to pro forma that for a year, we're not going to do it. And buyers and lenders won't pay for it either. If you have good comps and you're up 15 for a period or two, that's fantastic. And we're going to try and get some value there. But ultimately, you can't just pro forma that through the rest of the year and get value. Lenders will not give credit for it, and buyers won't either. So generally speaking, you know, reasonable pro forma adjustments, you have to be able to defend them. And not just, well, I think this is going to continue. It has to be very rigid, you know, and provable, or else you won't get credit for them. But you'll rarely see those types of things from us. You see some of that from our competitors every now and then. And when I talk to buyers about those, they tell me very clearly they're not paying for it. So it's not something you'll see from us generally.
We might show it as an example, but we won't actually pro forma it into the valuation. Just to kind of give you an idea of where it could lead in the future.
Yeah. So we've got 5 more questions in 10 minutes. Rick, is there one or two of these 5 that you think are more important to speak on than the others?
You know, I don't really. I'm just looking the final 2 from last year. We can pass by those. How about why would you sell now, and considerations for a buyer doing a deal in 2025? Those would be one buyer and one seller question. You know, why would you sell something now? Well, gosh, you're getting older. We talked about that, right? Maybe, maybe you're 5 years wiser and the stock market's up 70% in the last 5 years. And you might take 15% less on this business, but you just look at it as kind of a return on your life. And you're in a decent place to do it now. I think sales are going to be trending upward probably a little bit in 2026, depending on the brand. I even think some of the pizza category will start turning around, not because there's a baseline great shift in the way pizza is doing business. We've all read in the Wall Street Journal front page in the last week about how pizza is getting killed by all the, by all the other QSR kind of, entrants and such. But I think they're going to be rolling over such low sales over last year that eventually comps are going to be turning positive. You're going to see maybe some commodity costs mitigating into Q3 and Q4 of 2026. So generally, we're getting this like slow rebound, that kind of, and hopefully it continues to kind of build on itself without major problems geopolitically or what have you. So that would be one reason to sell into a slightly optimistic kind of time frame. And I think we'll see also with the big influx of emerging brands that are calling me all the time. I just kind of would say they're getting stronger. They're getting way stronger, and pretty soon they're going to be stronger than you. You know what I mean? And so. So you may want to consider that as you think about your timing and plan. Financing is there. If you have decent comps, there's plenty of deals to finance. 60% of the deals last year didn't make it to the finish line, which means that you still have commercial banks that are foaming at the mouth to make loans that didn't happen. So I got to feel like the environment for lending is fairly optimistic and rates are declining. So buyers are going to be able to pay more money typically and get financing a little easier than before. That's probably, you guys have any comments to that?
This is going to be very specific to the brand. And again, we're not going to exactly name the brands here. If you're in a brand that you might be worried about this, just feel free to give us a call. But as soon as that, what would you call it, Rick? The unwinding of the consolidators starts to occur. And again, this is going to be brand specific. 10 deals in a Burger King might not affect Sonic, for example, too much. But if you're in Burger King and you want to sell, it's going to affect you. So if you come out, if you're looking to sell and you want to go out right after that happens, it's going to affect your sale. It's going to reduce the value of your sale. But again, that's going to be brand specific. There are plenty of brands where you probably don't need to really worry much about that. And there are others where it might be a pretty big deal. So that's not going to be a macro comment to all QSR.
Yeah, well said. And then remember the big theme that we talked about. If you're scared, if you think what we're saying is right and there's going to be an unwinding of the consolidation, it's very possible that depending on the brand, depending on the time, that in the next 12 to 18 months, you could see a flood of stores for sale in your system that could knock your multiple down pretty hard. And so if you were going to sell something, you should get in front of that trend. Don't be the guy who's going to sell in January of 2027 or October of 2026, and then everybody sticks their stores on the market and cuts them up into 20-unit chunks throughout the year this year. All of a sudden, your strategy will shoot you in the foot. You know what I mean? And hurt you pretty badly. You could lose millions, and I believe that. It's very possible that could happen. Last question then would be, how about this? Some buyer considerations when doing a deal in 2026. What did we say last year real quickly? No problem. We'll move on. If we can't get to that answer real fast, let's talk about 2026.
Yeah, so last year, here, I got it, Rick. Buyer considerations, talked about Q1 sales and traffic. How is that looking? There was a lot of cold weather last year, which is, so far this year it's been okay. Like that could change, but that was a big topic last year. Commodity costs, that was another large concern. Pricing opportunities, how, is your pricing compared to maybe the neighboring franchisee? That's a big lever that, buyers need to consider. Look at the, kind of what stage of the brand are they in? Is this a growth brand, a legacy brand, and how's the relationship, with the franchisor? those were kind of the key talking points last year.
Okay. What comments would you make? Anyone feel free to chime in on buyer
I think a
considerations.
couple big ones this year. If you're looking at a deal, beef prices, they are pretty high this year. That's upside for a buyer in the future. I mean, obviously it could get worse, I guess. You can never say it'll always get better. But I think most people believe it will get better in 2027 or late 2026. So that's potential upside to a current P&L if you're a buyer looking at it. Obviously you can come up with all sorts of other negatives, but that's a real potential benefit. Development requirements. What is the brand asking for? How much do they cost? Can you get dirt with it? That's a big question as a buyer you should be asking. Some brands are a little more stringent on others or than others. And kind of a more holistic comment is, do you like your franchisor? Like I mentioned earlier, you don't have, as a franchisee in 2026, you don't have, in the bigger brands, you don't have the control over your business like people may think they do. I mean, it comes down to, do you have a good marketing person right now? Do you have a good C-suite? And if you don't, you're going to struggle. Like Rick said, it seems to be way more peaks and valleys, and it seems to be very dependent on what the franchisor is doing. Do you like them? Do you get along well? Do you feel like you have a voice? Can you actually get a hold of someone at the brand and voice a concern and feel like they care? If you don't, you should probably think about the brand you're in. Because
Or go to sleep for 2 years and wake up 2 years later when it changes.
Yeah. So do you feel like you're a burden to your franchisor, or do you think they actually appreciate you? Those are the questions, if I were putting my money to work, that I would be asking. And I'm getting those questions a lot from buyers these days. So that's a big one is the brand. Make sure you like the brand you're getting into.
Here's a question for another day. We won't be able to answer it here. Not even going to try to, but we're going to start seeing the unraveling of these large franchisees here. I wonder if that's going to happen at the franchisor level at some point too, when they suck all the, they either go public or have gone public, and then it becomes a non-growth story, and then they become private in the hands of private investors again. That's happened since the beginning of time. That circle too. So it'll probably come back around at some point. May witness it in a couple of years or so. But we are close to the end. Any further questions? Let's just make sure we monitor that.
There's one more. Have franchisors become more or less stringent? Compared to last year, I think no change. Generally speaking, they're pretty stringent, though. You need to be in the market. You got to put at least 30% down. Some brands are now requiring operational experience. So I won't name the brand, but there's a brand out there right now that if you don't have prior operations in the market you're buying, it's a 0% chance they'll approve you, period. No questions, no negotiation, no nothing. So it depends on the brand ultimately. The better a brand is doing, the more stringent they're going to be. But generally speaking, I say no change from 2025. And our comment in 2025 was they were getting pretty picky on who they allow in.
One of the things that Derek, you talked about earlier, it's interesting, was the fact that that's a kind of a subtle, quiet, incognito way for franchisors to push private equity out of investing in the space by saying that you have to either operate your stores or you can't buy stores that aren't contiguous to your other stores. That in effect leaves the brands to only approve existing franchisees or owner operators. And I think that trend is very clearly kind of coming out and changing. There's definitely a bent against the professional investing franchisee coming into these systems. There's no doubt about it for most of them going forward. People want operators now. And for my money, I would say that when the good old days happens again, where you have people who are operating 30 restaurants and know the band leader in their small town and their soccer mom and whoever in the heck it is, those are the types of restaurants and establishments that we appreciate the most, right? So don't be surprised to see it go back to the way it was at some point. Thank you so much for being here, for listening. We're very thankful for your time. Call us always if you have any questions, and be looking for an email, and then you can get the transcript on our website at unbridledcapital.com. Gentlemen, thank you guys for your time and expertise today, and see you all later.
Thanks, everybody. Take care.
Thanks, everyone.
Thanks.
Bye now.